we saw a market be down, then up, then down, then up, then down. So it's safe to say there's a lot of confusion at the broad market level, and that's not the only place we're seeing it. We're also seeing it at the Fed. The Fed is flabbergasted and confused by lots of things that have occurred, not just the strength of inflation, but also the economic data. Why? Because in Q3 and Q4 of last year, the economy was beginning to show signs of weakness. The economy last year was weakening. And then all of a sudden, in the first half of this year, particularly the first quarter, the rate of growth, according to the Fed, slowed down in the second quarter, according to the last Fed minutes, began to reaccelerate. That's right. Q1 was a stronger growth quarter for the economy than Q4 of last year. So, highly confusing because interest rates have gone up. The Fed has been shredding money. Money supply has shrunk. So, why is GDP growth increasing despite their best efforts? Now, that is a very difficult question to answer. It's very difficult to be an economist. Most of the time, economists are not precisely correct. This is why people like Warren Buffett and Charlie Munger say any company that has an economist as an employee has one employee too many, because it's very difficult and very unpredictable to be an economist. I don't know how many people on December 31st expected GDP growth to accelerate in Q1 when we believed that there were lag effects to inflation, and the Fed was signaling at that last December meeting that there would be additional hikes. So, I think it's okay to be confused, and let's tune out all the noise. Let's take a look at things where they stand, and let's try to see if we can give our best efforts to come to some sort of conclusion about where things stand and where they can stand. So let's start with the jobs data today. Yes, we did add less jobs than expected, but we also saw wage gains are still quite hot and not consistent with 2% inflation. If you ask the Fed about that, besides Goolsbee, they would say that the wage gains we've seen thus far are not consistent with 2% inflation. But they're still high. Inflation, still high. Core PCE, still high. If you look at the weird numbers that the Cleveland Fed put together last Friday, there were several of them. They're all much higher. Even the Atlanta Fed, which is led by Raphael Bostic, who's the biggest dove on the Fed, believes that inflation's high. And the Atlanta Fed was saying something about 6% last week. So, after reading the minutes, seeing some of these things, I definitely think the Fed is hawkish. But one Fed speaker today, who I have long considered to be the biggest dove on the Fed, I guess he might support one additional hike or something. So maybe he's the third biggest dove, technically, even though, it's very, very weird divergences here. Bostic doesn't want any additional hikes, but he does want additional tightening in real terms as inflation comes down. So, maybe he doesn't have the highest forecast, but he is the dove. And we'll talk about a potential surprise next Monday of new tightening measures that might be coming from Vice Chair Barr. Anyways, we did go on a little bit of a tangent there. I apologize. So, jobs data, what it could be indicating to me, my read on it is job growth is definitely trending down. We are having, lower and lower claims. This is good if it's paired with a fall in inflation, and we're hoping we get that. Obviously, the Fed doesn't look at food and energy prices, but it's possible energy prices go up from here, and all the CPI, fanboys are going to have to start taking second looks if that happens. And as far as I'm aware, most of the market participants are CPI fanboys. So I think oil's going up. That's been the biggest contributor to the fall in CPI. Could be the biggest increase if it's going to make a second run. Just saying. Anyways, I'm not yet convinced, and I don't think the Fed is yet convinced, that inflation is coming down. I definitely don't think today's report indicated that. If anything, it indicated the opposite because wage growth was strong, and I believe stronger than expected. And if you hear the Fed talk about core PCE, they say they're most concerned about the services side of core PCE, which is most directly linked to labor, and particularly to labor prices. So, I don't foresee, I haven't seen any information yet, that would indicate core PCE X housing, the Fed's primary focus when looking at its primary focus of inflation, is going to be a break in the trend. And if you heard Powell, pretty important guy, the last Fed meeting, he said, despite the rate hikes, there has been no progress on core PCE inflation. Wow, that's a bold, bold statement. You can look at that chart and say, it peaked, but then you have to consider the base effects. And when you take out and factor in the base effects, you can see it's rather flat. And it's been flat for a while. And might be flat yet again. So, who knows what's going to happen? But I see it being pretty high. And that's ultimately what matters. And that's why I don't think we really saw massive moves in yields today. Because unless it's a piece of information that's going to change the Fed's forecast, well, it doesn't matter, it seems, unless you're concerned about a recession. Which leads me to what my expectation is starting to be now that jobs are beginning to weaken. Earnings guidance, the last several reports we've gotten in the last week of Q2, Levi's the other day, also Nike, Micron, Samsung, just broader expectations I have given rates are higher, various other forces, student loan payments coming back into play, something we don't talk enough about, energy prices possibly going back up, is that, and what Amazon CEO Andy Jassy said about how consumers were previously paying sometimes for a more premium version of products. Now they're trading down any opportunity they get. Those were his words. Is that the economy is beginning to show signs of weakness, is beginning to slow down. This is what the Fed wants, but they don't see it enough, and they think a little bit more is needed, and it's nothing crazy yet. So, and some of them are even dismissing the lag effects. Anyways, what could happen if we don't get this fall in inflation quickly, and we need a pretty big fall in inflation because in core PCE, let's pull up real quick what the Fed is forecasting the year-end numbers to be in both unemployment and core PCE. So for the end of this year, they're looking for 4.1% unemployment. That is their projection, where it currently is the case that over half of the Fed members, I believe 2/3, expect 2 or more rate hikes. Employment is the other side of the mandate. So if it goes above that, one could safely assume maybe they would dial it back, or an unemployment rate above 4.1%. We just fell from 3.7 to 3.6. So that means we're going to have 0.5% of weakness in unemployment. That's a lot to ask for in a half a year. That is going to be felt. If that occurs, that is going to be felt. Okay? 100%. Then they also expect core PCE inflation to fall to 3.9. That could happen with housing, but it's, again, asking for a lot. And I think they were asking for a lot before, and they haven't been getting it because that projection was 3.6 at the March meeting, is now 3.9. So it's being revised up. and as is the unemployment from 4.5 to 4.1. So the broad trend of data is that it's causing them to get more hawkish. That is the trend. Don't let anybody, tell you otherwise. Try to glean on to one thing, one point, because here I'm looking at the projections right now, and they're moving. So another thing, the Fed isn't forecasting a recession. It would be absolutely insane for them to forecast a recession, just like it would have been absolutely insane for them to forecast prolonged and sticky inflation when doing such aggressive stimulus. But while they did increase their 2023 projections for GDP, they lowered their GDP projections for both 2024 and 2025. So they're not expecting, like the market is, this to be a quick in and out operation. They're clearly expecting a tougher battle. And right now, so far, the tougher battle has been on inflation. That is a little bit more difficult to predict, particularly with the potential energy prices coming. Just with that. That is a big deal if those prices come in, because they affect so many things. And, why is every other area of the economy, college tuition, healthcare, why do they get to be, experiencing massive secular inflation every year, but the price of oil is less than it was in like 2007? So I think it's completely justified for the price of oil to go up. And I think it's got plenty of room to run before there's an actual, demand contraction in the wallet, because it's just taken less and less wallet share, and it's taken more and more wallet share in the past. And it was there. It's obviously pulled back at times. We do want stability in that market. I'm just talking here. I'm just sharing thoughts of mine. Anyways, what I do think is easier to predict than the path of inflation is the potential path of the economy, at least possible, more likely outcomes for the economy. While the FOMC members aren't publicly saying they expect a recession, the Fed staff is and has been saying they expect a recession in the second half of this year. Interest rates have gone up. Consumer stimulus has gone down. Consumer spending is about to be allocated to student loans, of which some 13% of the population has. A lot of middle-class people, for sure, have that kind of exposure. I would say there's more headwinds than tailwinds. I think what we saw in Q1 was somewhat of an anomaly. I think that was a particular situation. And I don't know if that's going to be the new trend. And I think the market has moved as if that's the new trend, as if the interest rate fall after SVB was the new trend. And a few things are starting to go the other way. So we'll see what happens. That's today's video. And until next time, peace out.